Get to our market panel. Joining us now is Charlie Bobrinskoy of Ariel Investments and Victoria Greene of Squared Private Wealth. Welcome to both of you. Victoria, on the S&P, after, a little bit of a rally attempt in the last half an hour, we're right back about where we were a couple of days ago, even after the hot PPI today and the CPI that wasn't ideal. So what does that say to you about the health, the strength of this market?
I think the market's looking beyond some of the economic data. The assumption is, we'll still get rate cuts this year, maybe 3, not 4. We've been repricing that generally over the last few months. I think it was more concerned on retail sales than it was actually on the PPI. I think it was retail sales, and the concern is the consumer rolling over. To me, that's the big indicator we're going to have to look at. We need consumer strength. We need consumer spending to continue to drive earnings. And for me, earnings has taken front row to some of the economic problems, which is what we see in this rally continue. I will remind people, markets can go down. I know it's been a very long period of time since we've lost money at all in the stock market, but this is a very normal happening. We've been basically vertical since last October, so a little bit of a pullback, it's okay. It does not mean the market is rolling over and dying. It may just be a pause and a consolidation.
Okay, and Charlie, speaking of going down, the Dow, S&P and NASDAQ were just down fractionally, but the Russell 2000 was down almost 2.5% today. This, for value investors, they might be a little frustrated now with how this is playing out. So what do you do?
Bad day for me to be on today, no doubt about it. I've been making the argument that the S&P 500, obviously led by large cap growth, is stretching valuation, but that there's a lot more opportunity. The Russell 2500 value is trading at about 14 and a half times forward, whereas the S&P is over 20. But the problem is, on a day like today, when you get indications that maybe inflation is not dead, that maybe the Fed's going to keep rates higher for longer, that hurts names like housing-related names, auto-related names, some consumer-related names. And so today is a tough day to come on the show. We're long-term investors, not going to get rattled by one day. But there was some bad data. Frankly, the McDonald's announcements about soft consumer, the consumer eating at home more than going to a restaurant, if the consumer feels that McDonald's is a stretch, that's a little bit discouraging. It's one name, but it wasn't great.
Russell down just 2%, not almost 2.5%, I should mention.
Okay. Still a move, a significant move nonetheless. Victoria, if we're operating in a bull market here, how does this compare to what we've seen through history, recent history?
Yeah, and that's a great reminder. We're actually lagging behind the 2020 bull and the 2009 bull, and this is just a very normal bull market. People want to say, well, it's abnormal. This has happened before. If you look at the pace off the bear market lows, again, we're trailing those two. We're not quite in line with 86 and 82, but a little bit in front of those two. But when you look at it, it's a normal bull market. This is what happens. You are very rapid off the lows, and so none of this is something I see as abnormal, that we're getting way too stretched. If we continue to see the grow, which we can, if we continue to see increases in productivity, increases in margins, increases in earnings, we can continue to see this bull market run. I'm making the argument we're still in the early innings here, and while there may be bubblish tendencies around the concentration in technology, it's happened before, and it can continue to persist for years. It's not like we're going to roll over anytime soon. So for me, it's the bull is off and running, and we're going to have a little bit of choppiness. Very, very normal to have a 5 to 10% pullback, but this is all just a normal correction out of a bear market.
Okay. I just want to note that we have Adobe earnings, PagerDuty and Ulta all out. Our team is going through those results. We'll bring them to you as soon as they're ready. In the meantime, Charlie, when I look through your notes, okay, the moves we saw in the market today aside, when I look through your notes, you use the word dangerous a lot. What I wonder is, what is dangerous about this market?
That people are too bullish about technology and momentum. Momentum works until it doesn't. We have a lot of evidence that this rally has been way too focused in the top names, that they are way ahead of the rest of the market. There are indicators of market sentiment that are at record lows for bearishness. In other words, you have to go back to 2019 to get this low a percentage of people who were bearish on the market. Barron's just had a very bullish cover. That's not a good sign when Barron's is pounding the table. So I do not like the absence of fear. That's a little dangerous to me.